All right, quick look at the market action. Maybe we've got that saying, all good things come to an end, because we've been riding high since the Trump election. This morning, though, perhaps a little bit of a reality check could be setting in. Taking a look at what we're seeing for the broader benchmark here, we're 0.2% to the upside. US futures, again, a little bit high, but watching what's happening in Japan in particular. You've just got Taiwan as well coming online, a little bit to the downside. The trend could be getting a little bit disrupted by a number of different factors we can get into, but at a headline level, it's those expectations around what the Fed does in December, these chances, that level of conviction, a bit more caution coming into the state of play instead. What does the Fed do longer term if Trump's policies start to soak inflation? Stocks that we're watching in particular, well, TSMC is one of those just coming online to the downside this morning. The story around TSMC is actually a report we had out from the information, but essentially they're saying we could be seeing some sort of delays to the Blackwell chip server coming into production, bit of overheating, design issues perhaps, that could really weigh on Asian chip stocks. One, though, that is standing out to the upside this morning, and that is Samsung. So we already saw it gaining on Friday with the report. This morning, that confirmation coming through. Samsung is pursuing a major share buyback program, $7 billion. Of course, Samsung, we know it's been a company perhaps perceived to be a little bit behind in the AI race. But again, you can see that stock there, very much a watch. Let's take a look at what's happening in global equities, though, as we kick off another trading week, because here you can see actually we could be setting up for further losses. This line here, taking a look at that gradual series of gains we've had really since August. There's been, of course, not just these expectations around the Fed cutting into 2025. You had the China stimulus coming out, Trump's election, all positive factors for equities. Now, though, that trend has met some resistance. We're setting up the next line of support coming through in the 200-day moving average. Maybe not going to get there today, of course. That's about a 5% drop from here, but still something to keep an eye on. And let's change on, of course, how that plays into what we see for Chinese equities. Very much the laggards in the Asian complex. Again, those series of issues, taking a look at what we're going to see today, but pointing to a little bit more upside coming through. So, Dave, of course, what to watch really comes down to what we've seen in Hong Kong and that really big losing streak.
Yeah, I think 6 days in a row on the Hang Seng Index specifically, just to be more specific, Hang Seng China has been rather range-bound, or has done slightly better than the Hang Seng Index, of course. Now, all that being said, of course, the 19,000 level very much in focus. Are we going to get me in camera at some point? Maybe we will. We're looking at A50 futures, bottom of your screens. There we go, Belle. Just stand pretty as we change the page. Thank you so much. Belle's on her way back to the seat. As we look ahead to the equity markets today, this wrap in small caps. So the Chinex index is actually down over 7% over 2 days. So we'll watch that at the open today and what happens there. Keep in mind, of course, it's been 10 years since the launch of the Stock Connect. I remember almost like it was yesterday, really, us covering that and that launch, of course, that bridge between the Hong Kong and Shanghai and Shenzhen markets. Steve, of course, will be live on the ground for us there at the Stock Exchange. We have a couple of earnings to tell you about. Xiaomi is one of the ones, of course, to watch today. And apart from that, as far as data goes, unemployment rate out of Hong Kong, Macau GDP numbers. On top of all of that, we're also on weather watch. The city's under a Typhoon Signal 1 warning that I believe will remain in place up until 6 p.m. today. So watch for updates there. More so really as it pertains to maybe travel disruptions and the like, to keep yourself safe. Of course, markets, though, will continue to trade, of course. Right, this takes us into the Fed conversation right now. And, you know, as Belle was pointing out, this backing up on yields, the dollar strength story. I think dollar is up for 7 straight weeks, number one. Number two, dollar longs have been up for 4 straight weeks based on CFTC numbers. You're looking on your screens, the probability of a Fed move in December. So you split the difference between futures and swaps, call it a coin toss, odds, really, if you think about it. All that being said, so what does it mean for treasuries? The Treasury Index, year to date, we've given up almost all of the gains, so we've retraced back. We're still up for the year, but just half of 1%. And yeah, I mean, a lot of this has been down to the recent rhetoric coming out of the Fed.
Yeah, well, it's sort of that changing sentiment, really. We had conviction. As I said, it seems to be more about that story around caution and really that level of uncertainty, because officials, well, none of us know really how Trump's policies are going to play out and really whether that does lead to that reignition of inflation. But we've also been hearing from a raft of different people on the board. One of those is the Boston Fed President, Susan Collins, as well as the Chicago Fed President, Austin Goolsbee, on their rate cut outlook.
I think we're well positioned. I certainly wouldn't take another ease in December off the table. But again, we're not on a preset path. And so we'll have to look carefully at the data and see what makes sense when we get to December 18th.
I think we're going to be looking at rates coming down over the next year along the lines of what the dot plot said. So I still think we have a long way to go down with rates. There's some dispute about what is the neutral rate at which we're going to settle down. If there's disagreement about that, that we don't just charge right to it, that we slow the pace as we get toward it.
Joining us here on set is Shamaila, head of fixed income emerging markets in Asia Pacific at UBS Asset Management. It's nice to see you. Good morning.
Good morning. Nice to see you both too.
When did you get in? Yesterday?
Yesterday night.
Okay, so you're doing well on jet lag? Okay, we can get straight to it then. This backing up in yields, what's the assumption? How far do you think we can go in Treasury yields?
I think there can be volatility in the short term, but at this point in time, I think yields are offering a very attractive opportunity. If you have the ability to ride through the near-term volatility, we think that the market is overpricing the prospects of fiscal stimulus in the U.S. as well as inflation fears. So this is an attractive time to lock in some of those high yields.
Okay. Why do you think, though, that markets are getting ahead of themselves then? Why are you so confident that we're not going to see inflation coming back into the fore?
I think the market just overpricing the rhetoric that we've seen from President-elect Trump's campaign. And, you know, we know from experience covering emerging markets that what candidates say during their campaign may not be what they're actually able to implement during their term. Running a campaign is very different from running a country. And there are obviously, you know, we've just discussed the Treasury yields are starting to impact U.S. equity prices. So there will be caution in terms of what can be done with respect to tariffs and also with respect to fiscal stimulus. I mean, the U.S. really looks like one of the worst fiscal policies we've seen, even versus emerging market countries.
So if I was looking at sovereigns across the world, and maybe let's bring in part of your EM mandate, if it's, you mentioned treasuries might be a good opportunity, U.S. treasuries. If not this, what else?
I think emerging markets has been one of the best performing sectors in global fixed income, and some of the high conviction bets that we've had on specific emerging market countries have been one of the best performing financial assets over the last year. I mean, some of these countries which were considered distressed are up 50 to 80, 90%. I mean, take Argentina, for example. So these opportunities we think will continue to outperform over the coming years, and this is, I'm referring specifically to emerging market dollar-denominated debt. Okay. I do think that the strong dollar theme in the near term continues to weigh on EMFX. So we are not fans of emerging market local currency debt. We like emerging market dollar-denominated debt, particularly high yield and in the sovereign space.
Okay, well, just hold that thought. We have some breaking news right now. Belle, just apologies for the interruption here. Okay, so we're getting some lines coming through here out of Japan. So Governor Ueda is exchanging views, and this is really an event that's been flagged earlier on. So, okay, a couple of things, right? So they'll be paying attention to wage negotiations moving forward, number one, as a function of inflation. They're watching, he's basically saying they must closely watch the various risks as pertains to the U.S. economy. Yada, 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 it's important. We're also looking at, they will decide on policy by a meeting-to-meeting basis, given updated data and information, right? So if you just take a meeting-to-meeting look, as far as the BOJ is concerned, you look at swaps, a full hike is priced by March of next year. The possibility they move in January seems to split the difference when you look at consensus, although there does seem to be an emerging consensus, given how far yields have moved up and where dollar-yen is at the moment, that they might need to do something, whether that's signal, a change in tone, or actually move at the December meeting. You're looking at live pictures of Governor Ueda, and we'll bring you, of course, more information as they do cross, of course, the news tape. Yeah, Belle, go ahead, sorry.
Well, I mean, you're heading to Tokyo next, so how do you think that's going to play into your conversations you have there?
Well, I think the demand for emerging markets is something that's going to be across the region, right? Because you do want this to be the time where you're locking in some of these really attractive opportunities in fixed income. Similarly for Asia high yield, I think that's really where you have seen excellent performance, and we expect that to continue over the coming year.
Can it continue to gain, though, 80 to 100%?
No, not 80 to
Right?
100%. Do not promise 80 to 100%, and that was select assets within emerging market sovereign
Right.
debt. But you can easily get double-digit returns in some of these credits and countries because they have been so underpriced. Sentiment has been extremely negative, and valuations are extremely attractive at this point in time. And what you're seeing across the board in emerging market and Asia high yield, countries and companies are reducing, the default rates are reducing, and they are emerging from default. And that's a trend, I think, which will allow it to outperform other sectors.
Okay.
I understand that you think Donald Trump might not get all his spending plans across the line and all of those policies put in place, but something that does seem to have bipartisan support is the tariffs in some sort of capacity. So how are you sort of thinking about that in the emerging markets complex? Because obviously there's some places that really don't benefit, but others can, like Argentina, for instance.
Absolutely, you're 100% right. So what we're doing is we're differentiating in what we like in emerging market fixed income. EMFX, not so much. EM, dollar-denominated debt, Asia high-yield credit, not impacted by tariffs. And I think that's the key point, is you can find the pockets of value that will not be impacted as much by tariffs. And even with tariffs, right, it really depends. There are many ways of doing it which is not destructive to the global economy, phasing it in, diluting it through negotiations, all of which we expect to see over the coming year.
Speaking of Trump, so while we might be overplaying his threatened tariffs, some EMs have actually benefited, and there's also the other side of the trade, right? Some EMs might not be in a very good place if he, in fact, is able to carry forward most of these policies. You know, stack that list for us, both sides.
Absolutely. I mean, look, there definitely are beneficiaries. You've seen other countries in Asia where the trade has been redirected.
Right.
Mexico has actually been a beneficiary in the past, and right now it's in the crosshairs. So there will be alpha opportunities that will emerge through these headlines because you have to have active management to figure out who's benefiting and who's not. But that's part of our job, and that's what makes us great again.
Okay. Pardon the pun.
Pardon the pun.
Yeah. Okay.
China specifically, how are you thinking about which areas of the credit market are you looking at in particular?
I have to say, in Asia higher credit, there are very few companies actually, and hardly any companies that directly get impacted by tariffs. So we're really looking at a sector which is going to be mostly driven by domestic policy. And what we've really liked is distressed real estate. Again, for the reasons that I mentioned, you know, companies are emerging from default. The default rate in the sector has been going down, and the sector is much more diversified than it was before. So that's been an area of interest for us, and one that we think will continue to outperform going forward.
Yeah, okay, so that's one thing too. Is that a hard sell to investors?
It's absolutely a hard sell. China high yield has been a very hard sell, but we like hard sells because that is where usually the value is and where we can generate alpha for our clients.
And is that credit, is it a company-to-company basis?
It's absolutely a very, very intense bottoms-up analysis that we do on these companies. So it's really not just buying the sector and holding on to it. You need to be doing the analysis and on-the-ground research to find the value.
All right, Shamaila, thanks very much for your time this morning. That was Shamaila Khan. Come back to us when you're in Hong Kong next, head of fixed income, emerging markets and Asia Pacific at UBS Asset Management. Counting down, of course, the opens of trade in Shanghai, Shenzhen and Hong Kong. You're watching The China Show, and this is Bloomberg. Chinese leader Xi Jinping has told President Biden he's ready to work with Donald Trump to improve the relationship between the world's biggest economies. But Xi also used the meeting to lay out a warning on China's red lines. Bloomberg's Chinese economy and government senior reporter James Mager joins us now from Beijing. And James, do you think that there was really anything new out of the discussion between President Xi and Biden, or it kind of seemed a little bit more like what we've heard in the past?
I think actually the demands for the basic preconditions for the U.S.-China relationship were new. There was some more detail there, and I just want to read out what was in the readout. The Taiwan question, democracy and human rights, China's path and system, and China's development rights are 4 red lines for China. And I think, basically the government is making it clear that on all of these things, whether it's the primacy of the Chinese Communist Party in China, whether it's Taiwan, or whether it's China's right to buy things that it thinks it needs for economic development, none of these things are negotiable. And I think especially on the mention of the path and the system, which is the primacy of the Communist Party here in China. I think that is a stepped up rhetoric. I also think the fact that Lai Ching-te, the president of Taiwan, was mentioned by name in the readout is a stepped up sign from China that they are not happy with the situation with Taiwan and that they think he is even more dangerous to their idea of the status quo than previous President Tsai Ing-wen was. So I do think that actually this is a much more sort of stronger statement from the Chinese than we have seen in the past. And obviously it's clearly setting up the start of the relationship with President Trump when he comes in January.
Yeah, and James, I mean, it's worth noting, I think it was at the same event last year where this reset of relations took place. I think that was in San Francisco, and we're 12 months on. We had this meeting, which did seem to basically a continuation of what happened 12 months back. But do things hit a wall, you think, on January 20th?
I mean, if the Trump administration comes in and does the things they've been indicating they're going to do, I think the relationship is going to take a dive. Whether those actions are justified or not, the Chinese are going to react to the kinds of things that the Trump administration has said, or a future Trump administration has indicated that they will do. So, I think maybe you could say that the relationship has hit a wall. But I also think you can look at what China has done over that last year and point to things which are in direct contradiction to the things they're demanding from America. They say that the Americans should not try and obstruct their economic rise, meaning America should sell us the stuff like semiconductor technology or semiconductors that we think we need for our industrial development. At the same time, China is rapidly increasing its ability and its actions to control areas where China has an advantage. You're seeing increased export controls on critical minerals. You're seeing increased export controls on battery technology. You're seeing increased export controls on things like the processing technology for processing rare earths and other critical minerals. So on the one hand, China is saying, don't obstruct us, don't impose export controls on us. And on the other hand, they're doing the same to American businesses and companies that want to buy Chinese technology. So the relationship feels like it has hit a wall. But I mean, it's not just the fact that the Trump administration is coming in and is going to change that. There's problems on both sides, shall we say.
James, thank you. James Mager there, our China economy and government senior reporter in Beijing for us. Really on that same note, Goldman Sachs released its report out on the weekend. Dollar China goes to 740 onshore. So we're weaker on the Chinese currency. Looking at futures going into the open today, 0.7 of 1%. Speaking of the currency, there you go on the offshore rate. Plenty more ahead. This is Bloomberg.
Well, Alibaba just a little bit under pressure in the early part of trading this morning. A couple of stories to focus on. Firstly, we had the earnings coming through, pretty anemic outlook, concerns around the e-commerce business in particular. You've also got the company pushing ahead with a US dollar denominated and Chinese yuan debt repayment and share repurchase program. But let's get more on that now with our Bloomberg Intelligence senior analyst, Catherine Lim, joining us. And Catherine, kick off with the numbers that we had on Friday. Again, the concern around the e-commerce part in particular, it seems.
Right. Well, I guess what we saw on Friday really was that, the margins of the e-commerce company of Alibaba was under pressure. And we're talking about a July, August, September that was before Singles Day. So really, I think the trajectory into this current quarter with all the jazz that we've seen for Singles Day, that just means that, the margins will continue to be under pressure and a lot more, which, as I look at some of the consensus numbers, I do think that expectations for the e-commerce, profitability will come down this quarter and likely into 2025, depending on the entire consumer sentiment as well as, the competitive landscape.
Yeah, Catherine, they're doing some changes, at least given the bond offering, some changes to the capital structure. Help us understand why that's important right now, given where they want this company to be.
Right. Well, I guess, in a scheme of things, we are talking about very dynamic, factors coming in for this multi-business conglomerate that Alibaba is made up of. And clearly, they are still in the process of trying to dispose some of their physical retail assets, not forgetting that. And Sangeet has continued to actually keep the market updated that, talks are underway for the disposal by Alibaba. Notwithstanding, of course, I think Alibaba on the call last week, they've actually mentioned that, they are still keen to actually, seek US dollars funding, offshore funding, and really that is going to actually help their goal and still their commitment towards improving shareholders' yield via share repurchases and possibly dividends as we go into the end of the fiscal year.
Catherine, thank you so much. Catherine Lim in Singapore for us, our Bloomberg Intelligence senior analyst, unpacking the Alibaba earnings story. That stock, as Belle was pointing out, is under pressure. Going into the open today, that is more really an exception given how pricing is, and we are poised to open higher on the Hang Seng Index, 0.9%.
Yeah, a couple of analyst actions as well to keep an eye on ahead of the open today. Earnings focus as well, because we've got Xiaomi, for instance, has been rated a new buy at Northeast Securities, and Xiaomi is actually going to have its numbers out due later. Big focus, how they're doing in their EV division, because we've seen that sort of trend. Tech companies that now are EV players as well. So Xiaomi, how they're going with their new cars. SenseTime as well, that's been rated new buy at Western Securities. That, of course, being an AI player in the China market landscape, actually just celebrated their 10th anniversary. And China Resources Gas, again, new buy from another analyst as well.
Okay, we're up 0.8%, going into the opening bell today. Just over 3 minutes away, the Monday open is just ahead. This is Bloomberg.
Taking you to some live pictures from the Hong Kong Stock Exchange this morning, which is marking the 10th anniversary of the mainland Stock Connect. Of course, billions of dollars of trading volume flowing between Hong Kong and the mainland, starting off with equities, expanding to bonds, ETFs, interest rate swaps, but still investors want more. And what's interesting as well, Dave, is not only against the backdrop of this, we've seen futures looking like we're going to have a day in the green, even though we've had the likes of Morgan Stanley and Goldman Sachs turning a little bit more bearish.
Yeah, on Hong Kong. So they're, the latest rejigging out of Goldman Sachs in their sort of Asia-Pacific equity pie is a downgrade when it comes to Hong Kong and Thailand. They've upped the Philippines to overweight. Just note, of course, the Philippines, which also comes online in a couple of seconds too, did enter a correction very recently. And of course, we're just also speaking of the Philippines and the weather coming through the weather systems there as well. The opening bell here. Just really one note as well before we talk about the broader markets too, right? So on the 10th anniversary of the Stock Connect, in case you guys missed the announcement on Friday, so we'll be seeing a new Connect China Enterprises Index. Yep, so that's really a benchmark that tracks the biggest companies in the Stock Connect universe. Again, honestly, might be a bit confusing given how many benchmarks we're already tracking right now. But in any case, one more the merrier, right? 0.6% to the upside on the CSI 300. Speaking of Goldman Sachs, a call as far as the currency goes. 740 is where they think we could get short-term, I think 3-month view on the dollar, on the exchange rate. Now, given the threat of tariffs, and of course, this broader move up in the U.S. dollar, right? Dollar index up 7 straight weeks. Net longs in the dollar up 4 straight weeks, according to CFTC numbers. Flip the boards, please, and have a look at where how we're opening here in Hong Kong. 6 days of losses on the Hang Seng Index. It doesn't seem to be we're going to get a 7. We'll see how things pan out. Although we are up very strongly at the open, up about 1%, 19.6 right now on the Hang Seng Index. MSCI China is also up by about 1%. We have unemployment figures coming out later today as far as Hong Kong goes. GDP coming out of Macau as well. Alibaba in focus, modest declines at the open today, after the earnings, of course, which came out on Friday. Speaking of earnings, let's change things up and have a look at some of the movers we're tracking here as well. So you have Xiaomi coming up with earnings today. NIO's also out this week, I believe, somewhat, I think, towards Wednesday and Thursday. And speaking of Wednesday, Thursday, the big earnings event globally will be NVIDIA. Kingsoft is up out of the gates 1.4%. ADRs in the U.S. actually gained. Kingsoft Cloud actually was up the most on the Golden Dragon Index. High-Think Royal Flush. Okay, we're down 0.2%. This is, well, the story here is China's market watchdog has ordered one of its units, investment advisory service unit, from adding new clients and until they get that compliant. That seems to be the case. We're down modestly, though, 0.5% as far as that goes. But yep, of course, Bell, it's Monday, and the milestone we're hitting today, of course, is the 10th anniversary of the Stock Connect.
And of course, I know you said it was very confusing, Dave, but I do just want to recap one of the things that's being announced today at HKEX, because HKEX and Hang Seng indexes are going to be launching, as you said, that new index. It's tracking
another one?
Yes, but this one is going to track the largest Chinese companies in the Stock Connect universe. So, okay, they're calling it another innovation, but really it is that decade-long effort to try and integrate Hong Kong and mainland markets. And again, it just seems like investors want more. But they also want more on the timelines, because REITs, for instance, was something else that they said they were going to include, and then we haven't actually got a date on that just yet.
Yeah. And you look at live pictures, of course. And the reason I say it can get confusing is because I personally am confused sometimes when I get asked, what is the benchmark people use in China? And we look at Chinese markets, right? So you have MSCI China, you have the CSI 300, which is the 300 biggest onshore. You have the Hang Seng China Index, which is the benchmark here in Hong Kong, which tracks the biggest mainland Chinese companies listed in Hong Kong. You have the Hang Seng Index, which has a lot of everything else that I mentioned. And then you have this new one.
But is that just the ones that are included in the Stock Connect already?
No, not everything, which is why I guess this new product, again, addresses.
That's what I mean. But anyway.
There we go. I mean, the more the merrier. It's all about flow, right? It's all about flow. 10 years since the Stock Connect. It's estimated it's brought in, what, 3.4 trillion as far as Hong Kong inflows go. A couple of other things, too, that stand out. So there we go, over the last 10 years or so. And certainly as this tunnel widens even further, of course, the connection between the two markets, and really what hasn't happened is this closing. I remember when we covered the Open 10 years ago here, of the program, one of the things that actually people had predicted, which basically hasn't come to fruition yet, is a valuation gap closes between Hong Kong and China. And in fact, speaking of another index, there's another index on that too, the Hang Seng China Premium Index. That valuation gap hasn't closed as well, which I guess it's hard to predict everything to go through. Over 2 trillion Chinese renminbi in combined turnover since the inception. So yeah, this has really worked in many, many ways.
It has worked, but we're going to get more sense on it as well.
Why not?
Because our Chief North Asia correspondent, Stephen Engel, is at the Hong Kong Stock Exchange with our next guest. And Steve, talk us through all the products, all the innovations, and what's next.
Yeah, that's right. We're going to be speaking a little bit lower in volume right now because we do have the Financial Secretary, Paul Chan, speaking now on stage just after some of the Chinese officials as well have been speaking. And Paul Chan doing very nicely in Putonghua. So it's a very momentous occasion, of course, for the Hong Kong Exchange, celebrating the 10 years of the Stock Connect. Let's bring in our next guest, as we are going to be talking in hushed tones so we don't interrupt the proceedings. It's Nick Chui. He is for the Franklin Templeton Senior Vice President and Portfolio Manager. Thanks for joining us. So essentially, we just saw that the Hong Kong stock, or the HSI, the Hang Seng Index, is heading towards its first yearly gain since 2019. About time, right? What's your outlook, obviously, for the Hong Kong stock as we try to get some momentum from stimulus?
Thanks for having me today, Steve. Well, like you said, about time. And I think the key thing to understand is why we got here in the first place. Why we headed towards these gains that we haven't seen in the last 4 years. The policy support's important. It puts some form of a floor in valuations, but we're still some distance away from the mean if I look at the MSCI China average price to earnings. So that part of the valuation has repaired, but the real kicker is earnings. Right? If we see these earnings of companies recover, that will be the real kicker 2025, 2026 and beyond, because that will really lift the entire market, but that takes time, right? We've seen the policy come through, and we need to see more.
And there's just a lot of sentiment weights right now. The Chinese economy has not really recovered fully. There's been disappointment in the second round of stimulus. Trump is now going to be back in the White House, and if you look at the Stock Connect, if you invested money at the launch date 10 years ago versus the S&P 500, your returns would be about half of what the S&P 500 returned. So what's going to be the impetus, again, to get people, institutional money, back in?
That's a great point, Steve. And I think that spells opportunity, just given how much the market's lagged, because I think the real thing that's changed is the policy. That's the first thing. And the second thing that is slowly happening, and we expect to happen with the macro recovery happening, is the earnings itself. So, if we look at the picture from here forward, we've seen some shorter-term data sets improve. Right? You had the retail sales data last Friday, better than expected. You've had October property sales numbers. Again, I think the secondary sales beat expectations, and that would slowly translate into what I call the wealth effect repair. And as the consumer starts to think about spending again, as corporates think about spending again, that's a huge kind of funnel effect that we can see in the liquidity in the entire economy.
Now, with the Stock Connect program, we've had a lot of promises of action plans, but not a lot of action when it comes to certain things like a REITs Connect or a Primary Connect. So mainlanders can invest in Hong Kong IPOs. Primary Connect is what a lot of people are waiting for. What do you think needs to be done to move the Stock Connect from the first 10 years to the next 10 years?
That's a great question, because if I look at the Stock Connect and how it's actually introduced a seamless way of investing in the Asia market, it's a landmark creation, right? So if I look at that as a starting ground, the innovation behind the exchange and the Connect program is something that we need to focus on. And what's going to carry us to the next 10 years is the continued innovation. Number one, the continued connectivity between the exchange and investors. Right? Forums like this where you get investors kind of viewpoints, because investors' viewpoints are always changing, so that needs to continue to happen. Like you said, the different types of products, Primary Connect, REITs, etc., these at the margin will continue to help influence and increase the investable universe. Again, making it a lot more attractive for investors to think about the asset class and how they want to express their view. And again, I think these will come down the line, but if I think about the overall synthesis, it's about the innovation of the exchange and how that feeds into the overall investable universe of investors, and I think that will continue to grow in the next 10 years.
As an investor, are you getting enough proper transparency and communication from officials? Because there's been all these different promises, but we just wait for the action date to actually happen. Are you getting enough communication?
So I think if I look at that, the overall answer is yes, but I think investors' expectations might be different at different points in time. But the overall trajectory, if I look at the medium to long term and what they're trying to achieve, the answer is yes. Right? If I look at the policy pivot that's happened, it's about growth. But how they would deliver that growth, I think it's not a silver bullet they launch at a single period of time, but over a period of time. Same thing as the Stock Connect. It's over a period of time where I think the capabilities will be added on. And I think that's how investing in China has always been. It's about the long-term game. And like you said, given where things are right now, that's where the opportunity is relative to, I think, that longer-term picture.
What do you think the low-hanging fruit would be for the next steps that they can do? Make more companies that are eligible, connect them to the Stock Connect. There's the dividend tax waivers as well. There's the investable threshold as far as the minimum amount that you can participate in the market with. What kind of micro steps would you like to see?
Sure. And if I borrow the words of CEO Bonnie Chan, the micro-infrastructure, I think, is very important when it comes to the Stock Connect. For instance, what you mentioned is certainly all relevant. Other things I can think about include block trading, where, from an investor standpoint, execution and executing effectively and efficiently is always going to be important, right? So if you can do that in block, that's very simple. It makes it very liquid. Another thing is risk management tools. If I think about investors' needs, risk management tools related to Stock Connect, derivatives and hedging are certainly also things that we should be thinking about as we enhance the comprehensiveness of this Stock Connect program.
Yeah, as they like to say, this is a long march, not necessarily just a short little stroll in the park. Nick Chui, thanks so much for joining us. I'm sorry we have to talk in such hushed tones on this day, but thank you for joining us. All right, we'll send it back to you from the Hong Kong Stock Exchange.
Yeah, well, nothing like controlled enthusiasm there, Steve. Conversation there, of course, as the ceremony, of course, is taking place literally a few feet right behind them with Nicholas Chui there out of Franklin Templeton. Now, earlier on, Steve did speak with the boss at the Hong Kong Exchange, Bonnie Chan, who still sees a lot of room for the Stock Connect program to continue to expand.
I think we're still actually at the beginning. If you look at the volume so far, from the very beginning, southbound traffic has actually grown 50 times, and northbound traffic has also grown 25 times. And this is quite amazing. And if you ask me how we're going to continue to expand it, I'll say 3 ways that we're going to do it. First of all, products. We need to put more products onto the shelf. As you know, we started with stock, and then we expanded it to include bonds, ETFs. We're going to soon have REITs. But
we're waiting for that, though. Can I jump in and say there's no date yet?
Well, we're working on the details. I mean, certainly with every enhancement, we need to make sure that, all the screws are tightened up. And there is still a lot of white space that we can fill in. So that's the first dimension. Secondly, the micro-infrastructure, which is very important. We need to make sure that the users of the Connect franchise have a good experience. And I think, very recently we've proven that with micro-infrastructure changes, the market can be greatly enhanced. Severe weather trading, as an example. I think we've proven to the world that Hong Kong as a market has stepped up to that moment. And then third, but not the last, it's the fact that at the moment, the participants, I think it's still a relatively small pool. I've been traveling a lot recently, and I would say that the Connect story is still pretty novel to a lot of our friends in the world. And so I'm going to go out there and continue to market the Connect.
So right now the conditions are not necessarily ripe. You've raised about $9 billion this year, I believe. $5.33 billion last year. So it's better than last year, but it's way off of 2020. Was it 2020? There was $53 billion or something like that. Yeah. So you have a ways to go. So again, I'm going to come back to the primary Connect. Is it on the docket for next year?
Okay, so let's talk about where we are in terms of the IPO activities. And I'm very happy to report it, because last time we spoke, I think, in terms of our league table ranking, we are a little bit sort of at the bottom of the top 10, shall we say. We're now number 4. And we have completed a very big IPO, my dear, which is a $4.6 billion US IPO, the second largest in the world this year, and the largest in Hong Kong since February 2021.
SF Holdings possibly too?
I think they are about to launch.
They just announced that they've been ahead.
That's certainly going, hopefully, to bring our total fundraise this year to above 10 billion US, which I understand, right? Compared to previous years, it's a little bit sort of lower. However, I think you need to look at the relative ranking. And for the rest of the world, the last 2 years have not been a particularly conducive year for IPO activities. But, I think we have reached a pivot point, and I'm certainly seeing momentum pick up.
I have to ask you, what do you think is going to be the Trump effect on the Chinese economy and how that equates to capital raising, potential action against China, and the dampening effect possibly on the market here?
Okay, I know that question will come. Yeah. Now, to me, what we saw is that the week leading to the U.S. presidential election, the trading volume actually softened a little bit in our market. But as soon as the election is over, we saw the volume got back up again. So I think, with the presidential elections now behind us, there is now sort of the market knows how to move on, which is a good thing. To me, this is not the first time U.S. has Trump as the president. We've gone through that. What our market has continued to prove is that, whatever the conditions are, we have that resilience to make sure that we can ride the tide. So that's the important thing.
That was the HKEX CEO Bonnie Chan with Stephen Engle there, as we continue to watch live pictures from the Stock Exchange this morning, celebrating the 10-year anniversary of the Stock Connects program. We'll have more ahead.
Wow, champagne at 9:30 in the morning.
Well, it's a nice way to start the week, isn't it?
Yeah, there we go. On a high note, as they say. 10 years of the Stock Connect. Plenty more ahead. This is Bloomberg.
All right, let's turn to China's very well-known demographic challenges, really, and how they're planning to tackle that, because we know there's that uphill battle to try and restore population growth in the country. Now we've got a new study from Bloomberg Intelligence, and they're saying that the nation that's caught up in that demographic trap that was really set in place decades ago is leaving its population decline behind or beyond really any easy fixes. And I think we've really seen the ramifications of that already coming through. But our senior analyst, Ada Lee, joins us now for more on that report. And Ada, talk us through what you've found, because, as we said, there's been a number of policies. We know that restriction, of course, around single or what's it called again? The only child policy.
Yeah, one child policy.
One child policy has been well and truly relaxed, but it doesn't really seem like it's having any sort of impact so far.
Absolutely. So the government have been trying to boost birth rate by, some policy measures, and that's including cash incentive, boosting maternity, paternity benefits, making childcare easier. They've tried everything and almost exhausted all avenue now. So going forward, we do expect the population decline to continue, and with the decline, it could be dropping to about 1.36 billion people by 2035, and that's from the peak of 1.41 billion in 2021. So if you're looking at that, that means there's a reversion of population back to 2012 level. And putting this into context, what's more scary is that a drop of 51 fewer people by 2035 is 1.3 times the population of the entire California state, which is the most populated state in the United States. So basically, our whole California will be gone in 10 years.
Yeah, well, you could say the same. This is a joke, obviously, in California, but people moving out, that could be the same anyway. China's also making it easier for people to get married, and the other side of that is they're also making it more difficult for people to get a divorce. Should we expect more couples to get married, and will that encourage what it's intended to encourage?
Well, we're actually expecting the marriage rate to continue to decline despite all the policy measures. If you think about it, if you make it more difficult for people to get divorced, a lot of the youngsters are actually coming out to say, well, if it's so difficult to get divorced, why are we getting married in the first place? There are alternate ways to be together. So maybe people opt to co-live or other options. But that is a major issue now, because without them getting married, where are the children going to come from?
Yeah, and take a look at that chart there. We have the declining birth rate. I mean, you're going from 1980 to present, and it's well and truly a problem for China. But it's not, of course, just China that faces this sort of problem.
Yes.
What exactly can they do there? And I mean, I'm looking at sort of the tech side of it, but that's one of the reasons people have said that China's so invested in humanoid robots, is because they need to tackle this problem.
Absolutely. So in terms of this, we are expecting the dependency ratio to be quite skewed going forward, given that there are going to be a lot more older people as people live older, and then there will be less young people. So this skew of working force is a major problem. In terms of what they can do, we have seen other countries tried, right? We have seen South Korea, back in 2010 already, the health ministry of South Korea actually decided to switch off lights once a week, so that people can go home earlier to promote having babies. And it actually happened. And recently, in Russia, they also have legislated in terms of propaganda against having children. So they are trying everything. And will China go all these ways? I think maybe not as radical as these countries. They are still going through a more gradual process. As you can see, one-child policy, then two-child policy, recently three-child policy. Are they going to go to fourth, fifth, seven policies? We're not sure. But in reality, no matter how many children they are relaxing it to now, it's on the people whether they want to have babies or not.
Ada, thank you so much. Ada Lee there, Bloomberg Intelligence Senior Analyst. Plenty more ahead here on The China Show. Happy Monday morning. Yeah, a couple of things coming up on your screen. So on your right, aluminum stocks after China scrapping, well, on the down there. And of course, at the top is prices of aluminum, actually, traded in Shanghai. On your left are all the great interviews coming up. Well, hopefully it depends on me and Belle. Coming up in the next hour of the China Show.
Welcome back to the China Show. Taking a look at a really nice shot of Hong Kong this morning, but also what's happening with the Hang Seng, because we're just about half an hour into the session and you've got a bit of a bounce actually so far, up 0.8%. What's really interesting as well is when you take a look at the trading volumes, we're quite elevated, 50% higher than where we would typically be. Pretty good day for elevated volumes when you also think about the anniversary that Hong Kong is marking today, which is 10 years of the Stock Connects being in place as well.
Yeah, and there's a new index that they're launching, which I think will capture the biggest stock, correct me if I'm wrong, the biggest stocks included in the Stock Connect program, right?
Biggest Chinese companies that are included in a Stock Connect
There we
program.
go. We started with the confusion already. We will get to that. And to be honest, right, when we launched this, we were covering this at the very start. There was a lot of confusion, too, because it was really the first of its kind. It was connecting two markets. There was a lot of conversations around how this would work on the back end. If you'd have to connect to your broker here, and then how quick settlement would be. But here, 10 years on, we don't even think about that anymore. Things go very, very seamlessly as well. I think one of our charts earlier on showed over 2 trillion renminbi of flows have been so far.
And more to come, possibly, as well.
Yeah, and more to come.
That's what people want to see.
Yeah, it does put the markets a little bit closer to one another. HKEX index, 0.9% to the down, to the upside right now. Just to start things off, right, so we're coming off a 6-day losing streak on the Hang Seng Index. Obviously, we have a bounce today. Just taking a step back on the Hang Seng Index, from the time this major policy pivot started, which is the PBOC briefing on September 25th, I believe, or 26th, that week, we're back to effectively those levels within that range. Watch these levels very closely for our clients. You can get that chart, by the way, on your Bloomberg terminal. Perhaps we would be trading much higher were it not for Alibaba, which is seeing some modest downside today, about 2% post-earnings. Compared to how the ADRs did, we're still doing relatively better, and perhaps why we are getting a lot more volumes coming through. It's a big earnings week still, by the way, coming through out of Hong Kong this week. So you have Xiaomi today, you have NIO, you have Baidu set to report results as well this week to be more specific. Asia ex China and ex-Japan, we're doing slightly better, although you strip out, say, Japan, for example, and we're down about 0.7% on the Nikkei. The Kospi is interesting. That is a Samsung story. So Samsung was up 8% on Friday. I think it's still up about 5 or 6%, if not more, today on the back of this buyback program. So the Samsung story is basically a Korea story, and effectively that becomes an Asia story, just given how heavily weighted the stock is as well. Dollar is on a 7-week win streak, and as far as the Fed conversation goes, Fed fund futures and swaps, you split the difference. We're looking at effectively a 50% probability currently that the Fed does nothing at their next meeting, that they skip December as far as that high conversation goes. Right. So apart from this, I think Goldman Sachs they changed some of their calls around Asia.
Actually, a lot of them coming through, and it's interesting what you say about Samsung sort of leading the Kospi high. Today, actually, they've downgraded Korea to market weight, and part of that concern is around the outlook for DRAM and NAND demand, and also the weak domestic demand that they're seeing as well in Korea. Hong Kong, of course, a standout here because they're saying that, yes, the story around weak property, retail, that's behind that, but several others as well to note. Yeah,
I think the Philippines is interesting because this is a market that people were looking to buy into a dip. We went into a correction last week. We fell further. I think we went 12, 13% down from the peak. And they've now upgraded the Philippines to overweight as far as their allocations are concerned. So maybe buy the correction dip as far as that concerns. I think India is still at equal weight. That market, of course, also entering into a correction. So interesting note at Goldman Sachs to get us warmed up, of course. For this week, all the roads, of course, lead to what China does with its markets and what happens with its greater China equity universe, really, and how do we get a Santa Claus rally, or do we have to wait for more details, really, on how the economy responds to everything that's been said so far, Belle? Yeah, not just China stimulus. I think there's also what does the Fed do in terms of the direction of Trump's policies and how also
his plans around tariffs in particular play out. But let's bring in Janet Lee. She's CEO of BEA Union Investment, joining us exclusively this morning. And Janet, let's start big picture. And of course, we're looking ahead to trading for 2025. If you're thinking about investing right now, which markets are you looking at in particular, and which asset classes as well?
So first of all, good morning, David, Annabelle. Thank you for having me. As we are approaching the end of the year, and of course, many investors ask us how should they position their portfolio for next year. And I think that the very high level focus or what is top of investors' mind is definitely volatility, uncertainty, and therefore many of them are becoming more cautious. And so I think compared to in the past, when they plan for their investments across different markets in 2025 and beyond, they would look for investments that would help them to take into account geopolitical risk, perhaps a sector that might shield them from geopolitical uncertainties, and that can help them to achieve sustainable long-term returns. And then secondly, about the downside risk management, as we all know that by losing on the downside will take you double the time to get back to your previous level. And so they're more cautious on risk. And across the different markets, I'd say that we don't see a particular trend about I'm very big and wanted to overweight on a particular market. It's more about as I said, affected by the theme play. And then secondly, perhaps on a particular sector like the AI tech stocks, which certainly will continue to grow as they develop in the technology and further enhancements.
Right. And, you guys offer a wide variety of products and solutions and strategies right now. And what I want to get a sense of right now is between those strategies, there's a lot of uncertainty. How low does the Fed go? Can China reflate its economy? Is inflation still a problem? Would you say that income strategies are still the most popular, if not the most popular these days?
You're absolutely right, David. And especially in such times when volatility and uncertainty is heightened in the market, investors would look for protection and income strategy, which, of course, as always, is what retail loves. But at this particular point in time, they focus even more on that safety and stream of income for certainty. But aside from that, we also see that a bunch of investors where like what Annabelle asked earlier, weren't so sure about what to invest, then they might consider somewhat a broader basket of investments, something like a multi-asset funds, which enable or empowered the asset managers because they're closer to market to make the call. And these calls aren't traditional benchmark hugging calls, but they would be more tactical, dynamic allocation, perhaps with wider range of trading amongst cash, equities, fixed income to capture the opportunities dynamically in the market. So just to give an example, we have also revamped our global multi-asset funds, which we now use a quantamental approach, which is, by the name suggests, quantitative plus fundamental in managing the investments. And they looked at different factors in the markets to provide that signals and prompt portfolio managers to sort of look at where the trends might be, and they would take the bet accordingly.
And I'm sorry, just to follow up, are these for investors who are more tactical in nature, or are these for longer-term investors? Because I think it depends on your horizon, too.
Yeah. So these are for investors with a long-term investment in mind, for sure, because short-term volatility, we all know, is harder to gauge. But however, the fund is designed to have an absolute return target. So in a way that no matter is market up or down, so the fund would target to deliver the best absolute return on a risk-adjusted basis. And so as an example, this fund, for instance, from the beginning of the year until now, has delivered close to 9% of an absolute return.
Not bad.
That sort of dovetails into your other hat that you wear, because you're also the chair of the Hong Kong Retirement Schemes Association Executive Committee. When you're thinking about that longer-term horizon, how do you sort of guide investors? Which markets or products do you want to be looking at in particular?
Again, this is a very good question. And especially in retirement space, the sort of long-term would be even longer term than what we typically talk about for institutional investors, because we are talking about intergenerational and cross different government ruling and over multiple years. So that kind of sustainability would be even more important. And as we looked at the investment strategy of these retirement funds, first of all, it will have to be related to the nature of their retirement schemes or plans. There are different types, and broadly there might be defined benefits, there's defined contributions. There are some schemes with post-retirement options. So look at the time horizons that enable the investors to plan their investments. And then secondly, whether they are at which life stage or which stage are they at? Are they generally at the growth stage, or are they at the more conservative stage? Then try to consider the mix of the growth assets versus income assets in their investments. And of course, funding and adequacy is important because you can't squeeze blood out of stone. So if there's not enough contributions nor assets for investments, it's very hard to achieve the returns.
I know you guys just launched a bond fund, the Global Bond Fund, back in August. Can you give us an update on that, how that's done, what flows you've seen? And also, I noticed you guys don't have an ETF, right? Do you have a China ETF product?
No, we don't have
because
ETFs.
Because that's been very popular these days. Why have you not jumped in onto the bandwagon there?
Yeah. So let me tackle the first question first, the bond fund first. So we always have a long fund, but that's more of a longer duration bond fund. That's for the MPF investments, and of course safety comes first.
Okay.
And then probably around May, June this year, we observed that there is this tactical trend, as we were at that time expecting a rate cut in September and continuous rate cut, but of course now the picture may be slightly different.
They did one only.
But at that time we observed, that's the tipping point where investors might want something else as an alternative to their deposits or money market investments. Okay. So the team put their acts together to launch the short duration quality bond fund that focused to invest in the short end of the duration curve and provide security and also stream of incomes. The fund target to distribute dividends on a monthly basis and to aim for the type of investors who want that protection, less sophisticated, but they would like to try to gain exposure under this trend. And then on to your second question, David, you're right, ETFs are very popular these days, and we always highlight to our clients or investors that there's ETFs versus active management, or maybe we don't use versus because they are different ways of gaining exposures. There's merit to both of them. The important point is whether investors understand their underlying investments. So generally, investors believe that ETFs are cheap, they're efficient, and they enable them to gain access to the market in the most efficient and risk mitigated manner. And generally, I think it is, but each individual ETF might be different. Some might be more sophisticated, that's synthetic investments, and actually the fees might not be as low as investors think. And then active management, of course, the primary goal of the asset managers, and including ourselves, is to add value to the investor's portfolio on a risk-adjusted basis. And so therefore, the LPs or the investors will have to think which one fit their overall investment allocation, and whether they need the liquidity that's needed from listed securities, or whether they can afford some illiquidity constraints so they can earn the illiquidity premium. So it's about suitability and appropriateness for the investors.
Janet, thank you so much. And let's speak again soon. I wasn't able to ask you about the business for next year. I think we can talk about that next time, right?
Sure, definitely.
All right, Janet, thank you so much.
Thank you.
Next interview secured. Yes. Janet, thank you so much. Have a great week. I had hired your team, CEO there of the Union Investment. Still ahead here on The China Show, a pair of exclusive interviews coming up here, starting with Jonathan Bach, a group CFO at Philippine energy firm, and later...
We've also got actually Sangeet Kumar joining us. This is the CEO of an Ambani-backed humanoid robotics startup, Addverb Technologies. Of course, India also getting into the humanoid robots craze. This is a market very much dominated by China to date. We'll have more ahead. This is Bloomberg.
Good morning. Welcome back. You're watching the China Show. Just looking at my currency board here. Dollar onshore 723.34, offshore 723.80, almost a parity there. The dollar is in a 7-week rampage here, and Goldman Sachs actually sees both sides of the coin, leading to a weaker Chinese currency, particularly as you have President-elect Donald Trump set to impose tariffs on Chinese imports. Let's bring in our macro strategist for emerging markets. Marcus Wong is with us right now out of Singapore. Marcus, they say don't fight the central bank, don't fight the Fed, don't fight the PBOC. How hard do you see, or do you think investors should expect the PBOC to lean against this weakness in the currency?
Yes, hi. So I think we've seen basically today, we've seen stronger than expected fixings from the PBOC, a similar vein that we saw for the better part of last week. So I mean, it's clear that PBOC does not want one-sided weakness in the yuan. But of course, the larger question is, of course, how hard will they lean against it moving forward? So I think the PBOC, as well as a lot of investors, are you can say waiting for adopt a wait-and-see mode to see the actual tariffs that are going to be implemented. I mean, if you look at the Trump's first presidency as a base case scenario, the impact on currencies was actually only felt in 2018 when the actual tariffs were announced, not when the threat of tariffs was hanging over the market. So similarly, we could also see potentially a stronger PBOC response when actual tariffs are announced, once Trump comes into power next year. Of course, the question is how hard will they lean against, and I think the general feel in the market is that they don't lean too strongly against because they will have to contend with a weaker Chinese economy. Even though we saw better retail sales last week, stronger exports data recently, I think it's fair to say that the Chinese economy still faces fair amount of headwinds moving forward. So it will make sense for the PBOC to also maybe allow a certain sense of depreciation in the yuan to offset with the weakness in the economy.
And a lot of Chinese, rather Asian currencies, they not only need to deal with the yuan dynamics, they're also coming up a stronger dollar. So which ones are looking most vulnerable in that environment?
Yeah, it's a very good question, and I think if we look at the correlations between the moves in Asian currencies in the past 1 month, especially covering the U.S. election, and also back in 2018, the ones that really surface forth are essentially like the yuan, the baht, the ringgit, and Taiwan dollar. All these are particularly vulnerable to of course tariffs, essentially because all are very export-dependent economies. U.S. and China will rank among the top 3 trading partners for all these economies. And of course, with the dollar where it is right now, it is fair that it's a strong dollar trade. You see very few investors out there calling for, cross trades between different currencies, but mostly it's a dollar-Asia pair, with weakness in Asian currencies expected. Of course, the big question, again, for many in the market out there is how far will other emerging market central banks also, stem the weakness? I think what we saw, for example, is the dollar Korea shot past the 1,400 level immediately after the US election results were out. That was a level that was defended previously by the Bank of Korea back in April. But it's again fair to say that if it's a strong dollar momentum and it is the king dollar that's driving everything, and it's fair to say that with US growth exceptionalism being where it is right now, dollar Asia will continue to rise, and at most we could expect central banks to tinker at the sidelines to prevent excessive one-sided depreciation. But no one would in a sense come against this dollar rally.
That was our Bloomberg Emerging Markets macro strategist Marcus Wong there, and we'll have more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. Belle and I were just talking about 10 years ago. Speaking of, and why 10 years ago? Well, this week certainly marks 10 years since Hong Kong launched the stock trading link with mainland China. And earlier, our chief North Asia correspondent, Stephen Engel, in fact, sat down with the HKEX CEO, Bonnie Chan, who sees more room for the Stock Connect program to expand and grow.
I think we're still actually at the beginning. If you look at the volume so far, from the very beginning, southbound traffic has actually grown 50 times, and northbound traffic has also grown 25 times. And this is quite amazing. And if you ask me how we're going to continue to expand it, I'll say 3 ways that we're going to do it. First of all, products. We need to put more products onto the shelf. As you know, we started with stock and then we expanded it to include bonds, ETFs. We're going to soon have REITs. But
we're waiting for that, though. Can I jump in and say there's no date yet?
Well, we're working on the details. I mean, certainly with every enhancement, we need to make sure that, all the screws are tightened up. And there is still a lot of white space that we can fill in. So that's the first dimension. Secondly, the micro-infrastructure, which is very important. We need to make sure that the users of the Connect franchise have a good experience. And I think, very recently we've proven that with micro-infrastructure changes, the market can be greatly enhanced. Severe weather trading, as an example. I think we've proven to the world that Hong Kong as a market has stepped up to that moment. And then third, but not the last, it's the fact that at the moment, the participants, I think it's still a relatively small pool. I've been traveling a lot recently, and I would say that the Connect story is still pretty novel to a lot of our friends in the world. And so I'm going to go out there and continue to market the Connect.
So right now the conditions are not necessarily ripe. You've raised about $9 billion this year, I believe. $5.33 billion last year. So it's better than last year, but it's way off of 2020. Was it 2020? There was $53 billion or something like that. Yeah. So you have a ways to go. So again, I'm going to come back to the primary Connect. Is it on the docket for next year?
Okay, so let's talk about where we are in terms of the IPO activities. And I'm very happy to report it because last time we spoke, I think, in terms of our league table ranking, we are a little bit sort of at the bottom of the top 10, shall we say. We're now number 4. And we have completed a very big IPO, my dear, which is a $4.6 billion US IPO, the second largest in the world this year, and the largest in Hong Kong since February 2021.
SF Holdings possibly too?
I think they are about to launch.
They just announced that they've been
that's certainly
approval.
going hopefully to bring our total fundraise this year to above 10 billion US, which I understand, right? Compared to previous years, it's a little bit sort of lower. However, I think you need to look at the relative ranking. And for the rest of the world, the last 2 years have not been a particularly conducive year for IPO activities. But, I think we have reached a pivot point, and I'm certainly seeing momentum pick up.
I have to ask you, what do you think is going to be the Trump effect on the Chinese economy and how that equates to capital raising, potential action against China, and the dampening effect possibly on the market here?
Okay, I know that question will come. Yeah. Now, to me, what we saw is that the week leading to the U.S. presidential election, the trading volume actually softened a little bit in our market. But as soon as the election is over, we saw the volume got back up again. So I think, with the presidential elections now behind us, there is now sort of the market knows how to move on, which is a good thing. To me, this is not the first time U.S. has Trump as the president. We've gone through that. What our market has continued to prove is that, whatever the conditions are, we have that resilience to make sure that we can ride the tide. So that's the important thing.
That's the HKEX CEO Bonnie Chan speaking with Stephen Engel, and it's almost like investors or traders know that we're celebrating or marking the 10-year anniversary of the Stock Connects, because we are actually seeing Hong Kong and also mainland equities trading near their highs of the day. Big trading volumes coming through for Hong Kong in particular, 50% higher than average. But Alibaba actually is sort of bucking the trend today, falling after their earnings, that disappointing September quarter. And also Morgan Stanley has cut their price target by around 9% for the stock. So you're seeing that off around 0.4%. Quick change on to one of the big movers over in Seoul today that's dragging up the Kospi. That's Samsung. They're pushing through with a $7 billion share buyback. They are a company that's seen as being really missing out on the AI boom. This is how perhaps they're trying to entice traders back in. It's 11:29 a.m. in Tokyo. Japanese markets just about to go on their lunch breaks, and we'll see what, of course, happens over the next hour. But certainly going into the break, it's a pretty downbeat sentiment coming through for Japan, off 0.8%. But the reason we're seeing this mood really coming through here. It's not only have you had a wave of disappointing corporate earnings, you've also got Ueda, the BOJ governor, who's going to be speaking this afternoon, could get more indications around the timing of a rate hike. The Fed, of course, in focus with that expectation for December, sort of a coin toss. Do we see any sort of cut? Do they stay steady again? So that's what we're seeing for Japanese equities. Let's change on, take a look at what's happening in Hong Kong and mainland China, because this is very much a different picture and what's managing to bring up the broader benchmark. You've got stocks here gaining very strong trading volumes coming through for Hong Kong, 50% higher than normal, and lots of green on the screen here as we await, of course, more clarity, not just whether that stimulus measures in China take hold, also the Trump presidency and the sorts of measures that we see, not only tariffs, but what else Trump decides to do around things like climate as well. And that's also the focus of what's happening in Azerbaijan, because we've got climate talks from the UN underway, and a fight definitely is brewing over whether countries should recommit to last year's historic pledge to transition away from fossil fuels. Sources say that Saudi Arabia is leading a pushback against European and US efforts to reaffirm the pledge. They're using delaying tactics, and they're also looking at outright blocking it. A deal on fossil fuels made it to a final COP agreement for the first time ever last year, David.
Yeah, we'll really see where we end up after a couple of days, where the conversation goes into details that come out, certainly of COP29. In fact, a perfect guest we have right now to talk us through that and where they plan, of course, their businesses and really what happens there. Does that affect them materially, short and longer term? Joining us here instead is Jonathan Beck, Group Chief Finance Officer and Chief Strategy Officer at ACEN. The company, of course, is one of the leading renewable energy companies in Southeast Asia, and its power business is of the listed conglomerate Ayala Corp, of course, in the Philippines. ACEN does aim to achieve 100% renewable energy in its generation portfolio by 2025, which is next year. Jonathan, nice to see you, sir.
You too.
Let's start with COP29.
Yep.
In very simple English, how does anything that comes out of the fine print there affect, how you guys plan your business?
Well, we want to be a leading participant, not just in the development of renewable energy, but also in finding pathways for existing thermal plants to be retired. We still have effectively economic interests in a thermal plant in the Philippines, and we're engaged in a venture at the moment with the Monetary Authority of Singapore and with the Rockefeller Foundation to find a way of using transition credits to bring on the early retirement of that plant. But ultimately, and the COP29 is being described as the finance COP, I think, a lot of people.
Right.
And ultimately, money is what is critical to enable the retirement of thermal plants, and also to enable new renewables to be built instead of thermal in many of the, particularly in the developing countries, where there's still an enormous increase in growth for electricity demand.
Yeah, talk to us about that. Would you say it's easier now than it was 5 years ago to finance an early retirement of a coal plant, particularly in Southeast Asia, where still the energy mix is still, a lot of that is still coal, for example?
No. For sure it's easier now than it would have been 5 years ago. I think of 5 years ago, there was a lot of, people were kind of still feeling their way through, in many respects, what was really going to work. But we're now getting to the point where we're seeing concrete steps being taken by governments, bilaterally. Obviously, there's still a ways to go, it seems, before we have a true marketplace for carbon credits and transition credits, etc. But ultimately, we still think that that's one of the right things to do. And we know that there's a lot of controversy around it, etc. But ultimately, if we want to make these push forward, we're going to need all of these mechanisms in place.
And the path, you think, is clear and agnostic of, say, governments, for example. And the reason I bring that up, Donald Trump, for example, we're not sure, of course, what he's going to do. But how do you gauge that risk over the next 4 years with the Trump White House, for example?
Well, frankly speaking, we do think that there are a lot of governments in this world, not just the United States government, obviously, and we're seeing a lot of actions and initiatives on the part of many, many governments, particularly in this region. If you look at India, for example, where we've got a pretty rapidly growing business. The government there, as you may know, wants to get to 500 gigawatts of renewable energy by the end of 2030, which is a very ambitious goal. In the Philippines, the government wants to get to 35% of renewable energy in terms of the mix of actual output, but also by 2030. Australia has targets to get to over 80% of non-fossil fuel generation by 2030. These are all very ambitious goals that I think, honestly, are somewhat independent of what happens in relation to US government policy. Because each government, each economy has its own reasons for moving forward in this way. We don't think that that stops for the next 4 years, let me put it that way.
Right. I mean, you guys have big plans in India, which I want to get to in a moment here. But just talk us through your blueprint right now, and I think you have a broader target. 2030, I think it's 20.
We want to get to 20 gigawatts by the end of 2030.
Okay, where are you now? And looking at next year, where do you think you'll be at the end of next year?
Right, so we are right now at about nearly 7 gigawatts when you look at what we've got in operation, under construction, and what we call committed projects.
Okay. Which is part of the 7, or is that outside?
That's part of the 7.
Okay.
So we've got 3 gigawatts operating today. And then the rest is either in construction or very soon to be in construction, which is why we call them committed, because we've got board approvals and the funding is lined up, etc. By the end of next year, we would expect to be probably about 8.5 gigawatts in terms of the entire portfolio, including what's under construction. And frankly, the graph will start to steepen a little bit as we get towards the end of the decade. It's not that gigawatts, so to speak, are everything. This is a target that is not carved in stone, but it's an aspiration for us, a North Star, if you like. Because the truth is that companies like us should be doing this volume and more if we're actually to achieve all of the target goals that the governments have set, including the governments in the markets that we operate in.
Let's get to financials then. So 8.4 billion pesos, I believe, first 9 months of the year.
8.14.
8.14 specifically. That's a 20% jump over 9 months. I mean, is 24%, is that the norm that we should expect from the company on an annual basis? And next year, for example, where do you think you'll be?
Next year might be a tad lower than that, just because as you bring projects into operation, you get a lot of depreciation effects that start to come through.
It's that non-cash headache.
The non-cash headache. But if you look at our EBITDA line, we would expect it to grow at that rate and more, to be honest. As we plan out what we see our capacity doing over the next several years, we would expect, though, that the net income growth rate will be comfortably into the double digits, consistently year over year, with a CAGR between now and 2030 that should be, frankly, higher than what we've just reported for that 9 month to 9 month. But again, a lot will depend on how rapidly projects can be brought into construction and operation. I mean, as you know, it's not easy bringing very large-scale projects into being.
Especially in the markets where you operate as well, which is, I guess, that's another conversation I guess we can have in the future. You're making a lot of money. The question I have is, where you want to be, say, in a couple of years' time, also seems that you will need to raise some money at some point, if not early next year. Correct me if I'm wrong. How much, what's that cash call looking like? Or is that debt or equity or a mix of both?
Well, we will obviously continue to focus on debt financing, particularly project financing at the project level. For the bulk of, a typical project is kind of 2/3, 1/3 debt equity, especially and particularly where it's got good offtake, etc. Our equity requirements, though, don't go away. We would expect to raise equity in calendar 25. Not sure it'll be in super quickly in 2025 because we don't yet have quite that pressing need. But I'd say by around mid-2025, that would be that would be likely for us. And in terms of quantum, we've tried to be pretty transparent that we see it somewhere in the sort of around the $500 million US mark. And we've got existing very large shareholders, especially Ayala Group at 58+%, who are looking, we believe, they tell us, to put more money into the company.
Well, yeah, one would. And do you think that would normally be, would that be within the existing shareholder base, or is that going to be open to Have you worked out
That's
and looked at the details of that yet?
To be decided.
Okay.
But for sure, we know that we've got large existing shareholders, especially Ayala, that want to put more into us. So we'll need to align on the best mechanism for that.
Very, very quickly, India, just to very quickly, what should we expect from the company next year? What announcements?
We're already seeing a lot of growth in our Indian portfolio. There'll be a lot more to come in the future. We think it's a very exciting market, not just because of the government's targets, but because of the significant growing appetite, just growth in electricity consumption there. And India is very well suited to renewables, both solar and wind.
Okay. Jonathan, thank you so much. It was great to speak with you. Let's do this again. Maybe when you do cash call. Let's see.
My pleasure.
Let's do
Thank
that.
you, David.
Jonathan Beck there, Group CFO and Chief Strategy Officer at ACEN. Bill, I'll hand it back to you.
All right, Dave, great interview there. And of course, exclusive to the next exclusive, we've got an interview coming up with an Indian robotics startup that's backed by Asia's richest man. That's Mukesh Ambani, of course, joining the race to develop humanoid robots. We're going to speak exclusively with the co-founder and CEO of Addverb. That's next. And this is Bloomberg. An Indian startup backed by Mukesh Ambani's Reliance Group is entering the market for human-like robots, taking on US and Chinese rivals. Addverb says it will introduce humanoid robots next year with the ability to perform tasks across industries, including fashion, retail and energy. Joining us exclusively from Noida, India, is the co-founder and CEO, Sangeet Kumar. And thanks so much for joining us this morning. And I want to kick off with why you're making this transition, because Addverb is a company that has experience in industrial robots, ones that are used in warehouses, for instance. Why are you shifting now into humanoid products?
Okay, for us, it was a natural progression. We started with mobile robots, and we have been selling these mobile robots across the world. And then we moved to cobots, which was for industrial application and medical application. We parallelly developed quadruped. And for us, a robotic company has to have robots of different forms, and humanoid is one of the important form which will take on industry and help industry become more efficient. And that is why we decided to move to humanoid as well.
We're just seeing a picture here of the robots themselves. Humanoid robots, I mean, we've got some very promising companies that are coming from the US and China in particular. What kind of specifications are you building to here in terms of maybe the speed, the dexterity? What are you looking at in particular?
Yeah, so humanoid robot for us will be a form factor which is right now being built in US or in China or in Europe. It will be similar in terms of speed, in terms of height, in terms of dexterity, etc. But we are not stopping ourselves to only the humanoid which looks like human, because unlike, so humans don't have wheels. We invented wheels, but the humanoids of future will also, apart from walking like human with two legs, will also have wheels in certain form factor, which will enable them to be much more efficient. So we will not restrict ourselves to humanoids, which is exactly replica of human. It will be humanoids with other form factors, which will be able to do generalistic work. So today, because of physical AI or because of foundation models, which AGI enables us to do, so these robots will understand human beings in terms of the instructions which are given. And for the first time, even if those instructions are being given for the first time, they will be reconstruct or construct those instructions into subtasks and do that because they have been trained on substantial number of data or action.
As I said, Addverb is backed by Mukesh Ambani of Reliance Group. He's also, of course, known as Asia's richest man. How close is he personally to this effort?
So it definitely has its blessings, and we are Reliance is our largest consumer of robots, and also we are leveraging the skills which are there or technologies which already exist in Geo in terms of perception, in terms of the stack which has been built for some other application, the 5G, etc. So we are leveraging the strength which is available internally in the organization, combining it and trying to build humanoids which will be used in the industries where we are already present as Reliance Group, but also in other places, whether it is defense, whether it is space research, whether it is industries where there are hazardous works which are involved. So we will leverage the strength which is there in the group and combine that strength to build this thing.
You mentioned defence, and indeed military application is one of the possible uses of humanoid robots en masse. When do you see humanoid robots becoming sort of a national security priority? Because in China, for instance, that has perhaps a lead in this space, certainly the government has been making big efforts to promote and to build a national industry there. What sort of support are you expecting from India's government moving forward?
Yeah, so defense will be one of the largest consumer of robotics, whether it is quadrupeds or humanoids, and for different applications. And this is one important pillar of electronics warfare, including robots and drones are the two very important pillars of electronic warfare. Now, China is doing it extremely well. America has been doing it for some time. I think other countries would also start doing it. We have also been developing certain products specifically for defense application. And I think in future there would be few more companies coming up out of different countries, helping their government, and not only their government, but exporting it to other countries for different applications.
Given you're saying that defence will be one of the biggest customers for these types of robots, how are you thinking about your supply chain management then, and do you see the need to keep it insulated from external threats?
So, we will not, it is for sure that we will not be dependent on one country particularly. There would be our supply chain. We will take it from different countries, whether it is European or Japanese or other countries. And apart from that, what we have been doing in the last 8 to 10 years is we are doing a lot of things inside the company itself. So we are trying to build all the electronic boards which goes into the robot ourselves. So it is a vertically integrated robotic company that we are trying to build. But yes, you are right, supply chain, we will source materials from several countries so that we don't depend on one country in particular.
And big question, of course, is well, actually two. How much do you want to sell these robots for? And also, when are you looking to list the company?
Yeah, both the questions are, we have to decide what would be the selling price, and it is not only the BOM cost which decides that, it is the market which decides. It is what I believe firmly. So, and for different application, for different complexity, it will be different cost. As far as our IPO is concerned, it is still far. Right now, we are focusing on growing the company. We have now a presence in, so we have sold our robots in 25 countries. We want to further expand it, further go deep in these markets and grow the company. Once we are at a certain level in terms of scale, we will definitely think how to proceed further as far as IPOs concerned.
That was the Addverb co-founder and CEO, Sangeet Kumar. Come back and join us when you have those humanoid robots out for the market. But if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive TV function, TV Go. There you can also join the conversation by sending instant messages to our team and our guests during our live programming as well. Check it out. This is Bloomberg. Well, global equities are sort of taking stock of what the Trump presidency means for them, and we've seen sort of a bit of caution coming through. But certainly when it comes to that tariff question, it's going to be a standout point in the key earnings. We've got Xiaomi, XPeng, for instance. These are all Chinese firms that are facing the risks of tariffs in particular.
That's right.
And something to watch in the earnings this week. Xiaomi also one to note because it's due out later today, but it's really also been the EV efforts of the company, which are only for domestic use right now. They don't have production elsewhere, but they have done really well in a very crowded market. Interesting as well on the background of what's happening with Chinese equities. They're just going nuts over the last hour.
Yeah, we're trying to understand why. As far as what we can see on the surface, so in terms of market breadth, that seems to be very, very positive right now. 90% of stocks on the Hang Seng China Index are up to varying degrees of breadth, depending on the benchmark you look at. Certainly a weaker and a softer dollar is helping the runway slightly today on the Bloomberg Dollar Index, but it's not really across the board. I mean, the momentum still favors strong dollar at the moment. Dollar, Thailand on your screens. We did just get the GDP numbers, which came out about 20 minutes back. Now, on the HKEX Index, 2% higher. Volumes are on the lighter side compared to the 30-day average, but again, they have remained fairly elevated of late. It's a big earnings theme, of course, as Bell was pointing out through the course of this week. And, of course, just to time the geopolitics there, you have Baidu, and then you also have NVIDIA coming out at around later week, and of course conversations around AI there, and of course Ernie Bots, and of course NVIDIA, which is the poster child, of course, of AI there.
And an interesting one to note because we're coming against the backdrop of some downgrades from Morgan Stanley, Goldman Sachs have both cut their outlook for Hong Kong and China, concerns around the growth picture, but not playing into the story so far today, Dave.
No, well, it's only Monday, so the week is young.
All right, start the week on a bearish note.
Yeah, well, it's RV, I mean.
Could only go up from here.
Yeah, it only gets better. Because Linda Amin is just ahead. Speaking of.